Here we are, last video for chapter 13. We've got some reinforcement here of what absorption costing is. And so what they're going to do is they're going to distinguish between variable and fixed as far as coming up with a per unit cost. So what they've done here is they give us some numbers. And they give us all these guys. You see all this in green here is all given to us. We have raw materials and direct labor and variable manufacturing overhead amounts. So take sure you focus and look at that. And then we have fixed manufacturing overhead accounts. But notice too that the author of the solution here, he has separated the two. In other words, you got variable and you got fixed, and they're separated. And they've come up with a total variable cost and then a total with fixed added to it of manufacturing cost. Okay? And that's the distinction between these two, because we're going to come down here, we're going to divide those by the given number of 52,000 units to come up with a per cost per recorder, right? Digital recorder here, which is kind of an old term. I think this author needs to update the whatever they're manufacturing here. But anyway, having said that, if you take this 1,372,800 divided by those units, you get 2640. And if you take the total manufacturing cost and divide it by 52,000, then you get 2980. And each one of these, keep in mind, is a cost per unit. But one of them is just for variable and the other one has a fixed component in it. So that's why we call it absorption cost. Just a accounting terminology. But look in B. It says if 6,800 of these recorders were in finished goods at the end of 2019, then how much and in what direction would the 2019 cost of goods sold and operating income be different under variable versus absorption? So what they do first, guys, is they get a per unit amount that's associated with fixed cost. And you can do that by in two different ways. You can take the two amounts that we calculated here and we can just subtract the two. So you're basically the one with fixed cost and the one without. And so it's 340. But remember, you can also take the fixed costs and divide them by that 52,000 and get the 340. So you can get to 340 either way. And so that means that per unit, $3.40 of it is fixed. Okay. But they kind of put this on a spreadsheet here, a two-column spreadsheet. And they wanted to show you, notice the cost of goods sold here. And this is the 52,000 minus that 6,800 in inventory. Okay. So we actually have 45,200 here units sold times that 2980, which gives us an absorption costing cost of goods sold of the 1,346,960. See, now that means that this goes right up underneath sales, and it's subtracted out to give you then gross profit. Okay. Now you can either use absorption costing that has a fixed component in it, or you can use, remember, variable cost over here. You can see that in the other column, and you can use either one. It depends on the industry and what you're making, as to whether or not you use absorption or variable. But you'll see that when we take out the fixed costs out of the actual product cost and we set it aside separately, then we have to then include that in an operating expense instead of in the product costing, because guys, there's still a fixed cost involved. It's just a set total amount. But I want you to look at this. If you look down here, it says if variable costing of cost of goods sold is 153,680 lower than under absorption costing. That means if you're just taking the difference between these two, you're going to get 153,680. And then what they did here was take the difference in these two. So you're going to look you're going to have a 23,120 lower, right? This is cost, right? So that means it's going to affect your income by that amount. So you'll look here, this is more cost here than it is here. If we left the fixed cost in there per unit, then we actually have less cost than we would if we separated the fixed cost out. Okay. The difference in operating income under variable can be identified as the fixed manufacturing cost that remains on the balance sheet as finished goods inventory under absorption costing. The fixed manufacturing overhead associated with 6,800 recorders in inventory is the 23,120. Now look how they got this. They took the 6,800 that is in ending inventory and multiplied it times that fixed amount that we calculated. So we still get the 23,120. Now if we took, guys, in this and put it in a linear formula, we could take this fixed cost right here and take that variable cost per unit, and we could put any amount in there that we want within a relevant range, and we could determine how much additional cost we would have if we had an additional number of units that we were producing. So remember that it gets to a certain point where all of the fixed cost has been absorbed, then the only increase in cost on these 825 more recorders is going to be the variable cost, and that amount would be 21,780. So I know that gets kind of wordy, guys, but remember that however you put things on an income statement, whether you do it in cost of goods sold or you do it as a separate fixed expense, it has an effect on operating income in the way in which you deduct that sort of estimate that you're making. And just remember that any kind of cost per unit is an estimated sort of amount. Okay? So we're just kind of looking at the difference between if you were using your fixed cost as a part of your cost per unit, or you were just kind of blending them as a mixed cost, so to speak, or the difference if you actually pulled out your fixed cost and what effects that might have on your income. Might be a little bit different. So accountants can use either one. It just depends on the industry, and we have to be very careful when we change the way in which we do something. We have to make sure that it's generally accepted within that industry. So anyway, I hope I didn't get too much wordy with that last part of that problem, because this part is really, really straightforward, and you really need to know the difference here. Okay, so remember that A is very important on 1326. You might see that again on an exam. Let's go down here to 1328. And this is a problem, guys, where they just look at the problem and make sure you focus here. They're giving you a whole bunch of different numbers. And I want you to see that they ask you what the total cost of goods manufacturing is. Well, as soon as you see that, know that those other numbers are just red herrings. So you just need to focus then on raw materials, direct labor, and manufacturing overhead and come up with an amount. And take that amount and divide it by the units, right, that you were produced, and you come up with a cost per unit. And then they tell you, well, there's 2,200 units that have been sold, so you just multiply that cost per unit times together to get the cost of goods sold. So some of these problems are really, really straightforward and easier. They're not real highly complicated. But there's something that kind of is reinforcement for you that, hey, look, all this other information that you get from accounts in accounting, they're irrelevant to the question at hand here. Okay? Now, know too, down here in C, the difference between cost of goods manufactured and cost of goods sold. And between the two is 3,900 and 2,200. So that's 1,700 units. So the finished goods account's going to increase because you made more than you sold. So the finished goods account will increase by 82,722. How did we get that? Well, we took this 4866 and multiplied it between the difference between the two, 1,700 units. So that means that the cost of goods sold will be 82,722 less than the cost of goods manufactured. So that's very, very clear here, but just understand where those numbers come from.